So prepayment penalties are something that some people talk about, but then they totally forget. And also, it's something that pretty much nobody really underwrites. If you look at someone's underwriting for a deal, they almost always completely ignore the prepayment penalty in their underwriting analysis. So whether that be, and that's really for perm deals, because if you're buying a deal on a bridge loan, then you typically have a 1% exit fee, or it's a waived exit fee if you refi with them, et cetera. So if you have a 1% exit fee, okay, you just put that financing fee into your model. That's easy to account for. But what I'm talking about is longer term debt where you might have defeasance, yield maintenance, and things of that nature. People really, when it comes to yield maintenance, people kind of just turn their brains off and just say, well, that's something for us to kick the can down on and not think about. But the reality is, yield maintenance is what you need to think about the most because it's the most pernicious, most costly form of prepayment penalty. Furthermore, yield maintenance is a calculation. So it's not just a fixed penalty of, oh, I have to pay 3, 4, 5% of the loan amount as a prepayment penalty, right? So yield maintenance is a calculation which your prepayment penalty is correlated to to prevailing interest rates when you go to prepay as compared to the interest rate that you locked at. And the thing about today's environment is we have already seen rates come down quite nicely, which everyone's excited about, and that's starting to thaw the market and people are getting slowly back to business here. But in my opinion, there's still more room for rates to continue to come down on the long end of the curve. And what that means is you're right now, if you're doing a fixed rate loan for a 5-year, 7-year, 10-year term, you are potentially locking in a rate that is going to be higher than where treasuries are going to be. Treasuries are likely to be down a year, 2 years, 3 years, 5 years from now. Well, I don't know about 5, right? But we're at potentially like a medium high point in treasuries. So the thing is if you're going to have a yield maintenance prepayment penalty and prepay at a time when rates are lower than when you had originally originated the loan, your yield maintenance is going to go up. Whereas it's the opposite. Like back in 2020, when people were locking in long-term debt and they were geniuses for doing so because you were getting 3% money for 10 years, they didn't worry about the prepayment penalty at all because in their head, they're thinking, well, interest rates are likely to be up in the future, which is actually going to make our prepayment penalty cheaper because that's how the yield maintenance calculation works.